Hello everyone, this is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. So today's topic is capital budgeting. So what type of terminology we are going to use under capital budgeting and different definitions used in capital budgeting that I am going to discuss with you all. So after going through this topic, the learner will be able to understand the meaning and definitions of the terminology used in capital budgeting. So let us start with what is capital. So capital is defined as wealth which is created over a period of time through self-discipline to spend. It is a broad term for anything that gives its owner value or advantage, like a factory and its equipment. Either it may be in the form of intellectual property like patents or a company's or person's financial assets. Even though money itself can be called capital, the word is usually used to describe money used to make things or invest. So, whatever money we are going to use in order to produce the goods and services to earn revenue or to earn income, that is known as capital. Then, what is the meaning of working capital? The capital of a business is used in its day to day trading operations, which is calculated as the current assets minus current liabilities. Working capital is the amount of cash and other current assets a business has available after all its current liabilities are accounted for. Understanding how much working capital you have on hand to pay bills as they come due to critical to the success of an organization. The success of an organization it depends on the adequate resources of working capital available in the particular organizations. So we used to understand the total current assets and current liabilities. The difference between these two is known as net working capital, which is used to run the day to day operations of the business. And explain the term debenture. Debenture is a long term security yielding fixed rate of interest issued by a company and secured against assets. The word debenture itself is a derivation of the Latin word debere, which means to borrow or loan. So, debentures are written instruments of debt that companies issue under their common seal. They are similar to a loan certificate. Debentures are issued to the public as a contract of repayment of money borrowed from them, and these debentures are for a fixed period and a fixed interest rate that can be payable yearly or half yearly. Debentures are also offered to the public at large like equity shares. Just by issuing the equity shares, the companies can raise funds from the general public. So, debentures are actually the most common way for large companies to borrow money. So, this is one a way of source how the companies they used to raise funds from the public by issuing these kind of debentures. Then outline the term lease agreement. So, a lease is a contract outlining the terms under which one party agrees to rent an asset. In this case, the property either it may be owned by another party. So it guarantees the lessee, also known as the tenant, use of the property and guarantees the lessor, the property owner or landlord, regular payments for a specified period in exchange. So a lease refers to a contract where one party grants the right to use a property or land to another party in return for consideration and for a specific period of time. So both the parties enter into a lease agreement specifying the terms and conditions of the agreement. The agreement between the lessor and lessee is called a lease agreement. Then recall the term venture capital. Venture capital is a form of private equity and a type of financing for startup companies and small businesses with long term growth potential. So, venture capital generally comes from investors, investment bankers, and financial institutions. It can also be provided as a technical or managerial expertise. Capital invested in a project in which there is a substantial element of risk, typically a new or expanding business. So that is known as venture capital. Then what is meant by bank overdraft? An overdraft occurs when there is not enough money in an account to cover a transaction or withdrawal, but the bank allows the transaction anyway. The overdraft allows the account holder to continue withdrawing money even when the account has no funds in it and has sufficient funds to cover the amount of the withdrawal. Then elaborate the concept of capital budgeting. Capital budgeting is a process that businesses use to elevate or evaluate potential major projects or investments. Building a new plant or taking a large stake in an outside venture are the examples of the initiatives that typically require capital budgeting before they are approved or rejected by the management. So, in simple terms, the capital budgeting techniques are used to evaluate various investment proposals when the company has limited funds. The long term planning to make and finance proposed capital outlays. As a part of capital budgeting, a company might assess a prospective project's lifetime cash inflows and outflows to determine whether the potential returns would be generated by the company to meet a sufficient target benchmark. So, the capital budgeting process is also known as investment appraisal. So, there are different kinds of methods under capital budgeting. Basically, we used to classify them into two types. One is traditional methods, and another one is modern methods. So, coming to the traditional methods, they ignore time value of money, which includes payback period method and accounting rate of return method. So, these two methods based on the net profits of the organization. Whereas coming to modern methods or discounted cash flow techniques, they are based on cash inflows and which considers the time value of money. So, using these discounted cash flow techniques, the company will decide which is the most profitable project out of the available proposals. Then extend the formula of payback period. So, method of evaluating a project by measuring time it will take to recover the initial investment. So, payback period is the time required to earn back the amount invested in an asset from its net cash flows. It is a simple way to evaluate risk associated with a proposed project. An investment with a shorter payback period is considered to be better since the investor's initial outlay is at risk for a short period of time. The calculation used to derive the payback period is called payback method. The payback period is expressed in years and fraction of years. For example, if a company invests 3 lakhs dollars in a new production line and the production line then produces positive cash flow of rupees 1 lakh dollars per year, then the payback period is 3 years. So the formula for payback period is initial investment divided by annual cash inflows. So just by using that formula, one can find out the period into which the company can recover its initial investment, whatever invested in the business. Then, what is meant by ARR method? It is also known as accounting rate of return. Is the average net income of an asset is expected to generate divided by its average capital cost, which is expressed as an annual percentage. The ARR is a formula used to make capital budgeting decisions. It is used in situations where companies are deciding on whether or not to invest in an asset. So the asset may be a project, an acquisition, or anything which is based on the future net earnings expected compared to the capital cost. The ratio of annual profits after taxes to the average investment. So the formula for ARR is equal to average annual profit divided by average investment, where average annual profit can be derived by the formula total profit over investment period divided by number of years. Then coming to average investment, we'll take book value at year 1 and book value at the end of useful life of the project divided by 2. So like how we can find out average investment. So just by calculating this accounting rate of return, the company can able to know what will be its rate of return in the long run. The next discuss about discounted cash flows. So discounted cash flow, which is also known as DCF, is an analysis method which is used to value investment by discounting the estimated future cash flows. This technique can be applied to value a stock, a company, a project, and many other assets or activities, and thus is widely used in both the investment industry and corporate finance management. So, discounted cash flow or DCF is a common method of valuing investments that produce cash flows. It is also a common valuation methodology which is used in analyzing investments in companies or securities. The approach attempts to place a present value on expected future cash flows with the assistance of a discount rate. So the future cash inflows reduced to their present value based on a discounting factor, so which is also known as present value factor, and it can be derived by using the formula 1 by 1 plus r whole to the power of n. So using these factors, we can find out the present values of cash inflows and also net present value of the project. Then describe the term IRR method. It is known as internal rate of return, is the discount rate which makes the net present value of a project zero. In other words, if you want to describe IRR, it is the expected compound annual rate of return that will be earned on a project or investment. The rate of return at which the present value of expected cash flows of a project exactly equals the original investment. So, when calculating IRR, expected cash flows for a project or investment are given and the NPV equals 0. In other words, the initial cash investment for the beginning period will be equal to the present value of future cash flows of that investment. So, in simple terms, if you want to say this, like cost paid equal to present value of future cash inflows. Hence, the NPV equal to 0. Then what would you know about the net present value? NPV or net present value is the value of all future cash flows, either they may be positive or negative, over the entire life of an investment discounted to the present. It is a form of intrinsic valuation and is used extensively across finance and accounting for determining the value of a business, investment security, capital project, new venture, cost reduction program, and anything that involves cash flow. The excess of present value of future cash flows over and above the cost of original investment. So NPV is used to help determine how much an investment, project, or any series of cash flows is worth. It is an all encompassing metric as it takes into account all revenues, expenses, and capital costs associated with an investment in its free cash flow. In addition to factoring all revenues and costs, it also takes into account the timing of each cash flow that can result in a large impact on the present value of an investment. Then write a note on profitability index. So profitability index is also one method of discounting cash flow technique which is used in capital budgeting, and it is a measure of projects or investment attractiveness. The PA is calculated by dividing the present value of future expected cash flows by the initial investment amount in the project. It is a financial tool which tells us whether an investment should be accepted or rejected. The decision rule of PI is if PI is greater than 1, then accept the proposal. If PI is less than 1, reject. If PI equal to 1, may or may not. May or may not. So that decision, it depends on the decision maker whether they should go with the particular proposal or not. Then what is meant by discounting? Discounting is the process of calculating the present value of future cash flow receipts, and discounting takes into account the time value of money. A sum of money is worth more today than it is worth tomorrow. So discounting is the process of determining the present value of a payment or a stream of payments that is to be received in the future. So, given the time value of money, a dollar is worth more today than it would be worth tomorrow. So, discounting is the primary factor which is used in pricing a stream of tomorrow's cash flows. It refers to the act of estimating the present value of a future payment or a series of cash flows that are to be received in the future. The process of reducing the future cash inflows to their present values is called discounting. The defined complementary proposal. A complementary project proposal means a proposal for a project which involves coordination with one or more other projects for which funding was awarded under this program in a previous fiscal year, or for which funding is requested under this program in the current fiscal year. So, contingent proposal is one which is dependent on the other. Complementary projects are those that have a positive impact on the cash flows or profitability of other existing or planned projects. For example, a company that produces smartphones may decide to invest in a complementary project that develops wireless earbuds. So, that is known as complementary proposal.
Like, share, and subscribe. Hit the bell icon for more updates.